Just
Okay. Okay. So, first of all, I think, well, thank you for taking the time out on a Saturday morning. I know some of you, or many of you, actually have work, etc. So, I think we've started doing this, sort of meeting session once a quarter, and this time I think it's more, important because we've ended the year also, and ended the year not on a very happy note. The second part is that in the markets, things are not very hunky dory. Things are very uncertain. So it's a good time to sort of go back and look at what has happened and what can we look forward to. So with that, let me just quickly sort of summarize. I don't know how many of you actually read the investor letters that I write and share. I'm hoping at least some of you do. But let me reiterate, some points that I mentioned there. So first of all, I think last year wasn't good in terms of the performance of the fund. So if I look at the month on month kind of performance for every month, I think we kept doing well. At least, I mean, in Sri Lakshmi, we kept doing well till uh, roughly about December, and then it started sliding. And in Vriddhi, which is more of a sort of dynamic, momentum oriented, once the market started uh, reversing somewhere in the beginning of September, August, September, that is when Vriddhi started correcting. Now, so let us understand why what happened has happened, and what is the way forward with this. And because I know a lot of you may have questions, some of you have reached out to me, they've sent emails, some of you called. Uh, See, it's never easy when to see when your money going down, right? The drawdowns are always very, very difficult phase of any investment cycle. So if you put in 100 and after a while, if you see it's down to 75, 70, 80, whatever, that is a very, very painful process. But unfortunately, or fortunately, whichever way you look at it, that is the nature of equity markets. There will be times, and this is something that I take, I say this or I write this at every opportunity, in every investor letter, in every interaction that I have with people, is the one in four rule, right? So 1 in 4 years will be bad. 1 in 4 years will lose money, and that is something that is inevitable. There's nothing we can really do about it. Uh, that is the nature of equity market. It is not like fixed income. It is not like bond markets where uh, it keeps going up slowly and surely over time. The nature of equity markets is that it is volatile, and therein also lies the opportunity. If you look back, I mean, people who've been around for a long time in the markets, if you look back, every time there has been a panic, there has been an uncertainty. If you move forward a year, 2 years, 3 years, you always have this feeling that that was the time where we should have put in money, right? So just going back, if you see, uh, COVID was one such time. Uh, just before that, maybe the demonetization period that India had, that was another such time. Before that, uh, during the global financial crisis, that was one huge opportunity. So every big fall in the market, and I'm not saying that this is a big fall. Actually, this has not been a big fall. This is a standard, once every 2 3 year kind of a fall where the market falls 20%, right? So this is something where in hindsight, we will always feel that this is a time when we should have invested more in the markets. So that is roughly what broadly I would wanted to talk about. One is that right now, even now, right, there are a lot of uncertainties. So, if you open the media, you will see that there are every day there is news about something or the other that is going to go wrong. We're going to have a war with Pakistan, that US tariffs is going to go this way. Mr. Trump obliges us every day morning by tweeting something or the other. Uh, China responds with something, Japan responds with something, somebody else responds with something. So this is right now in a flux. So what is the way forward? That is I think the more important part. Way forward for India, for our economy, and more importantly for our fund. So let me take them one by one, and then maybe we'll have a more. We'll open it up for discussion. We can have questions and answers. So first thing is, my expectation is that within a few more months, maybe we've already started May. So my guess is by May and June, we will see a lot of the volatility in news flow, not in the markets, in news flow. So, Trump saying something, India, Pakistan, something happening. All of this is going to sort of reduce significantly, because that rate of change is what is more important for markets, right? So it is not the absolute uh, news flow, but it is how fast things keep changing. From a US tariff perspective, I think India is very well poised. We would probably be the first country, if not the first, the second country where we will have some kind of a trade agreement. We need to be, uh, we need to, get into the details of what that trade agreement is going to look like. But it's not going to be, something which is going to be dramatically bad for India, primarily because, we are the stuff that we import from the US, it's not something which is very high on criticality or importance for India. So, reducing tariffs, for example, on Californian almonds or Harley Davidson bike is not going to make any difference to the Indian economy. Uh, the tricky part may be, the agricultural produce, etc. And even then, I'm more or less certain that US is not going to sell us rice and wheat and maize and things like that. It is always going to be more high end, avocados and blueberries and blackberries and those kinds of stuff, which is anyway consumed by a very very small niche, so not going to be materially different. Whereas compared to what India sort of sells to them. The other part is, I think India has already signaled that we are importing oil and gas from the US. So a large part of the trade deficit is going to anyway get addressed there. So I'm not too worried about what tariffs are going to do to India. Uh, Conversely, if the trade tariff war sort of between China and the US sort of subsides. Obviously, this 145% kind of tariffs is not sustainable from a US standpoint, also from a Chinese standpoint. Uh, that will sort of come down somewhere. I don't know where, 10, 20, 50, whatever percentage it comes down to. Definitely over a longer period of time, it is going to give a uh, fillip to India, Vietnam, Indonesia, Malaysia, these kinds of countries where some amount of uh, manufacturing is going to move. So long term, I think we are sort of going to be extremely bullish. So that is one part of the tariffs. The India-Pak war. Now, very difficult to sort of comment on something where practically no one knows anything. Uh, what is going to be the response? I mean, how it is going to look like, when it is going to happen, if it is going to happen, if we are going to do covert operations. So basically, nobody knows anything. So this is in that zone of unknown unknowns, right? So this is what probably is keeping the market on tenterhooks right now. People are thinking that if we get into a war-like situation, we might see one more leg downwards. Whether that breaches the previous, low that we saw earlier in the beginning of April, uh, if that is going to happen or not, nobody knows for sure. Uh, so that is the Indo-Pak kind of a situation. Uh, what else is sort of you know bugging us at this point in time from an overall economy macro perspective? Yeah, the third thing is somebody asked me yesterday, what is going to happen to the Indian economy if or the Indian society if the caste census thing plays out, if we get more reservations, etc., etc. If we get reservations in the private sector, how it is going to impact us. So I think it's far too premature right now for us to sort of think on those lines. It's just an announcement has been made. We do not know what is going to get measured, how it is going to get measured, what are the implications of the caste census that is being rolled out, how it is going to impact us. For all we know, it's going to be used for targeted subsidies, etc., etc. So I think it is too premature to worry about things. Another thing that I wanted to sort of share is if you go back and look at history, right, 40, 50 years of market history in India, you will find that every year or every 2 years there's something to be worried about, right? And in hindsight, you will actually not even remember 90% of those things, right? And that is the nature of how things are. But when it is happening, it becomes a very big issue. And in the last 10 years, it is more so because of the media, because of social media, everything gets magnified, right? People who are in Calcutta, right? Who are from Calcutta, just remember that, pretty much a year back, what was the situation in Calcutta with the RG Kar case, right? We were thinking that common people were out on the streets. There was so much of things happening around us, and if you look back now, 1 year later, a lot of people would have maybe not have forgotten about it, but it is now somewhere in the completely at the back of people's mind. It's not there at all somewhere. Okay. Uh, so that is on the news flow and things that will happen. Now coming to our funds, right? So we've seen a significant drawdown in our funds starting from March. So starting from September, October onwards. In Vriddhi, we've seen a significant drawdown. Lakshmi, slightly lesser, but I think January onwards, we've also seen a drawdown. Now, first of all, why is that? Let's understand it. Why did we see a fall earlier in Vriddhi and much later in Lakshmi? There are two reasons. One is the different strategies that we follow. Vriddhi is more fast, momentum oriented fund where we are trying to play short cycles. Now, in this kind of a fund, typically, unless there is a trend in the market uh, and a market becomes choppy or it goes down, it tends to underperform, right? So, and this is going to happen, like I always say, this is going to happen once in every 3-4 years. The fun part is that we tend to make much more money when the market is going up than the index, and when it falls, obviously, because our focus is on stocks which have high beta or which move faster than the index, obviously it falls slightly more. So that is one part. In Lakshmi, what we've seen is we fell much, much later than the overall market. In fact, till about end of December, we were performing significantly better than the market. And the reason is what happens is when the market turns around and sort of goes into a bear phase, people start selling their holdings, right? And the last uh, ones, the last to get sold are the ones where people are making money, people are holding on because the fundamentals are good. That those are the stocks that get sold the last, and that is why we saw that our stocks fell only in the end of the rally. Right? So that is the reason why we sort of fell at the fag end. Now, some of you may be wondering why the markets have turned around. If I see Sensex, Nifty, they have sort of gone back to retraced a lot back to the highs that were there, if not fully there. But our portfolio has not gone up significantly. Why is that? And I think there's a question also in the chat where Money is asking that the I continue to hear mid and small caps are still overvalued, and since our funds primarily focus on them, how do you see the risk and plan to? So that's a very very good question. Uh, so what typically happens is that when again after a bear phase, when you know uh, investors have lost money, especially if you see retail investors, they would have bought a lot of shady kind of stocks, people, stuff like Gensol, etc., and they would have lost a lot of money. What tends to happen is once the market starts turning around, they will start buying into the large caps and the mega caps first, thinking that they are blue chips. So you will see people buying into an HDFC Bank, into a Bajaj Finance, into an ITC, into a Hindustan Lever, Reliance, and these are the stocks which start moving up first. So what happens is the index, which are very very heavily weighted towards this mega caps, they start moving up. Now pause and fast forward, say a 6 months or a 1 year period, you will see that uh, over say 4 5 year periods, it is always the mid and small caps which perform significantly better than the large caps. Why is that? It is very very intuitive that a company with say 1 lakh crore or say a company which has uh, 20,000 crores of profits, for it to grow 20%, it needs 4,000 crore of profits to come incrementally, right? Which is very difficult. Whereas a company which has, maybe 50 crores of profits, to get that 20%, you just need incrementally, maybe 10 crores. And that is why small caps and mid caps tend to outperform over a longer period of time. The agility is there. So as long as you are buying, companies which are reasonably well managed in sectors where there is tailwinds, over a period of 2 3 5 years, 10 years, you will do much better buying companies which are growing, and that is what we do. We don't want to change uh, our strategies because of short term. Things can go here or there. Uh, so we don't want to do that. That is one thing. The second thing, in terms of why the index has sort of done comparatively well over the last 1.5 months is financials have started doing well. So banks have started doing well, and financials are like 35 to 40% of the larger indices in terms of weight. So once when HDFC or a Kotak or ICICI or HDF or a Bajaj Finance starts doing well, or an SBI starts doing well, it disproportionately moves the index. Also, some of the other large companies like ONGC, Reliance, they have done well because of the geopolitical situation with crude oil, gas, things like that. So the point here is that we don't want to sort of miss the forest for the trees. We want to. The whole idea is to be able to generate significant wealth over the next 3 to 5 years, as compared to uh, what we can do by buying very large cap companies. Because let's face it, an ITC or a SBI is not going to double its profits in the next 2 to 3 years. It's not going to happen just because of the size of it, right? An HDFC Bank is not going to double its profits in the next 2 to 3 years. Our focus is to look for companies where we think that the profits can double in the next 2, 3, 4 years. That is where the spot we want to play, and that is what I have done for the last 20, 25 years that I have been investing, and that has given me phenomenal dividends, phenomenal returns, and I don't see that that is going to change in the Indian markets. In fact, on the contrary, in fact, this Sunday I had the privilege of being on a very small closed door lunch gathering with two stalwarts, Ramesh Damani and Govind Parikh. And the main discussion around was that everybody in that room was super bullish on India over the medium to long term. And I'm not saying the next 6 months, 1 year. Next 6 months, 1 year, nobody really knows what is going to happen, and that is not true of today. It is going to be always true. At any point in time, if you look back right now, last May, right? If I remember correctly, last May, I think Vriddhi was one of the top 5 performing funds in the country, and uh, everybody was so bullish. All commentators in the media was very bullish. That India is going to do great, and then things started turning around. So nobody really knows how the next 3 months, 6 months, 1 year is going to be. But over the next 2 years, 3 years, 5 years, 10 years, uh, is India better poised than what we think uh, in the gloom and doom of today? I personally think that it is going to be, and I've been saying this, that we are in a phase where there is going to be tremendous amount of wealth to be created uh, in the next decade. And my personal belief is that in the next decade, uh, you know, we will be, as a country, as a group of investors, we will make more money than what we made in the last 10 years. And I'm pretty much convinced. And one of the reasons, or the few of the reasons why I think that is going to happen is that, uh, again, you look at history, we only look at some things which are in the recent past. We've forgotten that between 2000 and 2010, emerging markets like India significantly outperformed the US. It is only after the quantitative easing, after the global financial crisis, that the US markets picked up and started performing better than India. After and then that was from the 2009 10 period onwards, and then we saw a maybe a once in a generation kind of a move with the tech stocks, where Fang and then whatnot started picking up, and now AI. But if you see, uh, there have been long periods where uh, US has not done well and the emerging markets have done phenomenally well. And I think we have already got into a phase which has now sort of been exacerbated by Trump's actions, uh, you know, where emerging markets and countries like India is going to benefit. It will benefit from one, core business flow, two, from a large amount of money flow that is going to move out of the US and come to India. And not only India, I mean, India is going to be one part of the whole piece. It is going to move to China, it is going to move to Vietnam, it is going to move to South Africa, it is going to move to Malaysia, Indonesia, uh, Mexico, a lot of these places. And I think that is going to be a huge decadal opportunity. I know our last, say, a month, 2 months, we've been talking to management. I've spoken to many managements, formally, informally. uh, what I'm hearing is that there are significant on ground inquiries from European businesses, from American businesses, of moving away from China to India. I mean, this was happening in a trickle. Now it is sort of opened up as a deluge, because now people think that uh, you know uh, now people think that it has to sort of be a concerted effort of moving away from China and de-risking. So I'm personally very bullish. Medium to long term. I have invested in Lakshmi and Vriddhi additionally in December. I am down in my both my funds like 20-25% from there. Uh, and whatever incremental money that I earn from here on, my personal plan is to keep adding to the funds. Uh, I'll tell you why. The thought process behind adding to the funds is that if you look at absolute returns from equities or from our investments, right? Returns will it comes from it's basically it is ROE, right? Return on equity. So if I have 100 rupees in the portfolio and I get 20% returns, I get 20 rupees. Right now, if I am able to keep adding to my portfolio and my overall portfolio goes up to 500 rupees and I still make that 20%, my absolute return goes from 20 to 100 rupees. Right. So the whole game is about continuously incrementally adding to my portfolio so that a year, 2 years, 3 years, 5 years, continuously down the line, my overall return and on absolute scale goes up. So that is what I personally have continued to do always, and intend to do that, even in the future. Archana has a question on the chat. Hi, Abhishek. You mentioned in one of your emails that you've made some changes, additions to the rules of selling. Can you please elaborate? Okay, thank you, Archana. At least I know that one person has read my investor letter. Makes me feel good. So yes, so what we've done is, uh, you know, typically when do we decide to sell, right? So first of all, we sell when we get a better company to switch to. So I have a very focused portfolio. I don't want to buy a little bit of every stock and end up looking like a mutual fund. So uh, so the idea is that if I get a very good stock idea, I will replace it with something existing in our portfolio, right? So my lookout in Lakshmi is we will have between 15 to 20 stocks, and in Vriddhi we will have between 8 to 12 stocks. That is ballpark that I look at, unless there are exceptional circumstances, right? So first rule of selling is if you get a better company, then you have to look at which is the least conviction idea in the current portfolio based on uh, how you think it will perform in the next 1 to 2 years, right? So that is the first criteria. Then the second criteria is when the management does something negative, or when there is a policy change, then you go back and relook at that business, and maybe your thesis is not playing out, right? So a very important case in point is, say, Nagarjuna Construction, NCC. We exited that stock when I found that there is a significant hold up in government ordering, and this is an infrastructure company. If you don't get orders coming through, then you have a problem. And I have lived through the 2004 to 2007 period where all large order book companies, suddenly those order books start looking like stories, right? Because the actual orders don't sort of flow through, and then you are holding a company which has nothing to do, and the stock price just collapses. Once we saw that the order flow again has started significantly, we just changed course and bought it back again. So that is one thing. I'm just trying sort of to give an example as to when do we think of selling. The third is when we see that there is a significant headwind in the industry, right? So something fundamentally has changed in the industry. So for example, we sort of exited KPIT when we saw that IT, there is going to be a significant headwind. So that was when we sort of exited KPIT, and these are kinds of bets that we want to take, always looking at the next year, 2 years, 3 years. The third is we will look at it when our stop loss is hit. Now, in a very choppy market, what tends to happen is that, if your stop losses are very, very narrow, then you will continuously keep hitting stop losses and taking losses, right? So what we've, you know, tried to do is we will try to exit when the major trend sort of changes. And this is something that we are, sort of slowly incorporating in our process. And you might see that, we are not exiting individual stocks, but because there's nothing majorly wrong with those individual companies, but the overall market regime looks weak. In which case we take proportional bets of exit. So we will might exit 20% or 30% all across the board. So that is something that we've sort of started incorporating to protect major downfalls. See, now this is a two-edged sword, right? What typically can happen is we might end up selling at a time when the buying or when the market fall is nearing an end, right? That is always the risk that is there when you take a cash call or when you take a stop loss kind of an exit, right? Any kind of stop loss is always going to reduce sort of overall returns over a longer period of time, because whenever you get out, the risk of getting back in is always going to be there. How do you decide when you get back in? And typically in the markets over history, what we have seen is there is something known as a clustering effect. Now, what is clustering effect? It says that basically large down moves and up moves tend to cluster together or happen together. So you might find a few days or few weeks when the markets fall a lot, and then suddenly it sort of reverses course. And we've seen that happen during the COVID period, when the market continuously falls and then it continuously moves up. So at one point, when you sort of decide that, okay, I will get out, and you get out and maybe the market falls a little bit more and then sort of sharply reverses, you miss both the last leg of the fall and the first leg of the up move. And you are never sure that if it is going to be so I'll give you a practical example. Right now the market has sort of made a bottom, it has moved up, but you are never sure that whether it is going to go for one more leg downwards, right? If we have a war, is it going to go back one more down? And if you listen to the media, you will have 100 people giving you 100 opinions. Somebody will say, Nifty is going to go down to 20,000. Somebody is going to say that Nifty is going to go to 30,000, right? It is always known only in hindsight that what is going, that this has happened. Before the event, you will never know. It is always a game of probabilities, and that is how you will have to play it, right? So the major change that I'm incorporating in our process is that we will go with graded entries and exits. The next question is Anoopji's question on the chat. So should we continue with STP and SIP? Kindly guide. I mean, I would very, very strongly urge all of you to, go for STPs or SIPs, if not, one-time infusions. So I'll give you my rationale, right? At some point in the next 1 to 2 months, if not, if it hasn't already happened, it will happen. I mean, the bottom will happen either from 1st of April to somewhere in the end of June is what my estimate is. I could be wrong, but either it has already happened or it is going to happen in the next one to 2 months. Now, in that kind of a situation, what I am trying to do is we are trying to get into some of the strongest stocks, businesses that can outperform in the next 2 to 3 years, right? I don't like losing money. I am down 25%, like I said, in my funds in the PMS. My entire, for a lot of you, you have, investments in other things. My entire net worth is in equities, in the funds, in the stocks that we have. So I have to make money, and no, so my entire focus is on generating wealth in the next 2 3 years, 2 3 years, 5 years, and I'm convinced that whatever money that I've made in the last 10 years, the next 10 years I'll make more. Not in absolute terms, but in percentage terms. Absolute terms, obviously, it will be more because the portfolio base has changed. But in percentage terms, I'm more convinced that we will do significantly better. So my suggestion, my thought is that if you don't have an SIP, start an SIP. If you're doing STP, great. Just focus on increasing, if possible, right? I mean, not everybody is in a position to increment their portfolios, but if it is possible, these are times where in hindsight, after a year, after 2 years, you will feel that उस टाइम पे तो पैसा लगाना चाहिए. So that is basically what I wanted to share with you today. If you have any questions, either you can put it in the chat, or sort of maybe you can unmute yourself and ask the question, whichever way you feel comfortable.
So the question,
Yeah. Sorry. Who's this? I'm unable to hear.
Alok Kumar Shahi ji, you're audible.
Okay. Yeah. Yes.
Alok ji,
Yeah.
you may unmute yourself and ask your question.
hello, yeah, I've unmuted myself. Am
Yeah.
I audible?
Yeah.
Yes.
Yeah. You
Yeah.
can hear you.
So first, thank you so much for keeping a lot of our money safe, because these were very turbulent times, and it was really nerve-wracking for all investors. But my question going forward is, which is the themes that you think are going to work? And if you have certain themes in mind, are we going to have a more compact portfolio in the Sri Lakshmi? Because there are 20 odd stocks that may represent the total market, but they are not. But in case you feel that there are certain sectors that are going to run, will we have a more weightage to them or not?
Okay. So
Thank you so much, sir.
yeah. Thanks, Alok ji, for your kind words. I think so. First of all, I think just a general point. Uh, Most of you, you've been with us in this journey in the fund for about 3 years. In fact, this month we will complete 3 years in the fund. Some of you joined us later, and I'm sure, or I hope that it will be a long-term journey. The fact is that this kind of nerve-wracking fall is going to happen every 2 3 years, right? Where we will, feel that everything is going down and everything is going to end, the world is going to end. Uh, but it doesn't happen that way. We will continue to perform well. We will continue to create wealth. Not because we are great, but simply because uh, India is going to do well. I'm very, very convinced about that. And because the strategies that I personally follow is a growth oriented strategy, and I think that in a growing economy, if you are a growth investor, uh, there is no way you will not make money over a longer period of time. So that is my conviction, and I'm 100% invested in my conviction, right? I don't invest in mutual funds, I don't invest in any other funds. This is what I do, and I have 100% of my personal wealth in all of this. Coming to your questions of what themes, so I think the most obvious answer to that is in the next year, 2 years, what is going to do well is the domestic consumption theme. Now, in that domestic consumption, there is a huge, huge number or a wide band of sectors. So you will find, I think, manufacturing picking up. Uh, you will find within manufacturing, if you see pharma, I consider pharma, although it is a separate sector, but it is also something where we are manufacturing products. You see chemicals, you see uh, capital goods, infrastructure. These are sectors which are going to do well. Interest rates are on a declining kind of a mode. So if interest rates go down, banking financials will do well. I am not long-term bullish on banking financials, but short to medium term, I'm very bullish on banking financials. Uh, so I think that is going to do well. Housing finance is going to do well. Infrastructure, like I said, defense, again is a no-brainer. 27 countries in Europe have already committed to doubling their defense budget. Europe does not have huge manufacturing capability. So a large part of that is going to be outsourced. It is not going to get outsourced uh, a lot to China. So where else it is going to go to? Some countries like Sweden, like Czechoslovakia, uh, these are Germany obviously have very strong defense manufacturing capabilities. A large part will go there. A trickle will come to India, but that trickle is going to be significantly larger than what the Indian companies can ever envisage and maybe cater. So, defense looks like a no-brainer. Electronics, right? The huge amount of focus, if you look at where the government is spending, the focus of the government is on defense, it is on electronics, it is on semiconductors, it is on railways, it is on, roads, ports, airports. That is where the government is spending money. And that is where I think the entire focus is going to be for the next 1 to 2 years, where where the globe is going to be on a boil. The challenge that we will face, and one of the reasons why there is so much of uncertainty still around in the global markets, is that here you have two large elephants in the forest who are fighting, US and China. And we are all, if you look at it, even though we may not like it, but we are all the small, animals around. And when two elephants are fighting, it is possible that others might become collateral damage and get trampled, right? So if the problem between US and China is not resolved quickly, what will happen is that the overall global growth is going to shrink significantly. And if that happens, that is going to impact business across India, across the world. Now, let me give you a simple example. A very large part of the consumption in India happens because of the IT industry. A large number of people are employed in the IT industry who get paid significantly above the median salaries. So they then go ahead and consume, right? Spend a lot of money on consumption items. If there is a long-term challenge because of AI, because of US going into a recession to the IT services business, then obviously we will see less recruitment, we will see job losses in the IT sector, which is going to again indirectly impact the Indian consumption. So these are all second order, third order derivatives of what might happen. We will need to keep an eye out of on these things. Now there are two things which is going to play out in the shorter period. One is for short to medium term. One is the tax breaks that the FM announced last in this previous budget. That is going to come through from this month. So people's salaries, take-home salaries would have got slightly improved in the end of April. So some part of it is going to go to consumption. My take is some part is going to go to housing finance, because big ticket housing can be bought because disposable income is going up, interest rates are coming down. So that is one area again where I'm very, very bullish on. So if you see in In Lakshmi, we've bought a housing finance company. We bought a large cap bank like Kotak. So short to medium term, I think these might tend to do well.
Abhishek, we've got a couple of questions from Adarshi
Yeah, let me go
in
through
the chat.
the chat. I see a lot of buzz around Dr. Lal, Path Labs, Divi's Labs. Do you have any thoughts on them and if they will be included in Lakshmi? I think Divi's we already have. We sort of bought. Divi's is is one of my favorite companies. Let me sort of make this disclosure upfront. I've on and off held Divi's in my personal portfolio in the fund pretty much over I think last 10-15 years. So Divi's is one of my favorite companies. I'm very, very bullish on Divi's. So we already have it. Dr. Lal's also is going to do well. I am actually looking out for in the diagnostic space. I'm looking out for Vijaya and Thyrocare more than Dr. Labs. Also evaluating a couple of others in the space, but I'm more inclined at this point in time towards Thyrocare and Vijaya. We're actually doing a detailed analysis on that. I don't know if and when it will get a place in the top 20 in Lakshmi, but that's the way it is. Let me see. What about Bajaj Finance? Okay, that's the next question. Which is issued bonus and split. Do you think it's worthwhile to invest in Bajaj Finance? Going further, if any plans to, I don't think Bajaj Finance. I think it will do well, but is it the best bet in the NBFC space right now? I don't think so. One, because of its size. I think it's going to get constrained. The amount of competition that it is facing is phenomenal. So I don't think Bajaj Finance is going to get it as easy. So I bought personally in my personal portfolio, I bought Bajaj in 2010, and I sold, I think in 2021, 22, I forgot when. So there was a time when Rajiv Jain's voice was there in my brain, right? Because I had listened to so many con calls, and I pretty much knew what was the answer that he would give to any particular question. But I think the space has changed significantly. There's too much of competition. The time when they were like the only player in the brick and mortar space, that has sort of gone down there. Now there are other players. In online retail, everybody is there. So now I think the pendulum is slowly swinging to the larger banks. So let's see. We do have plays in both Lakshmi and Vriddhi in terms of NBFCs that we've got and banks. Okay. Next is a question from Saurav. IT sector is hammered current and the guidance they're giving is not very pretty. How long do you think it will take IT companies to get the growth if American recession is around the corner? I think, see, like I said, American recession is one part of the problem. The other part of the problem is their business model, IT services companies, is actually getting challenged today because of what AI is doing. Right? Today, you can actually get AI to write 30, 40, 50, 60% of the code. Right? So what happens? So all our, the TCS, Infosys of the world are basically headcount into dollar rate. Right? They were in the glorified body shopping business, if I may call it. And this might not go down well with people in the IT industry, but that is what they were doing. Right? There is no differentiation of service quality, etc., between any players. The other challenge is the rise of the GCCs, right? These global capability centers, they are opening up. They are, uh, sort of getting into the same talent pool that these IT services players were playing into. So the overall market size itself is shrinking. So these are genuine headwinds that the IT, players are facing. Now, what are the bullish side? The bullish side is now look at AI. How much of AI are you going to use only as as a chat platform? एक point के बाद तो you get irritated now using chat GPT. You want real world applications. You want AI to be integrated with stuff that you use on a daily basis. So mail में AI होना चाहिए. You want AI to be integrated into maybe creating documentation, creating a Word document, creating a presentation, booking your travel. Uh, uh, so this concept of agentic AI or AI agents, that is going to slowly pick up. Now, AI agents are not going to write itself. It is, going to be, it has to be written by some of these services companies. So more and more AI adoption will mean more and more work in AI, integrating AI into business applications. So that is what I expect the next wave of growth to be driven by. But that is going to take a bit of time, right? It is not going to happen immediately. So I think uh, IT services, the business wise, is not going to turn around very easily. It might take 2-3 quarters, maybe a year more. Stock wise, there will be pockets where some of the stocks, for example, just look at the results of KPIT, Persistent, some of these more product sized companies, and they've done actually quite well, right? Compared to their services peers. So there will be pockets where companies will do well, and the stock prices might go up. But that is slightly different from a secular growth, which is what we want for multi-baggers, right? We want multi-baggers in our portfolio where we will create disproportionate wealth. That can only happen when two things happen: when earnings grow and when price grows up, goes into momentum. So these two things has to happen together for us to get multi-baggers, and that is where we have to that is the pond where we need to fish. Okay. Next question is from Gagan. I notice a frequent changing and chopping of stocks, especially in Lakshmi, since September 4. Some stocks remained in the portfolio just for weeks. You are right. I wanted to understand the thought process behind it. Is it because of the changing macro situation that has led you to make such? Absolutely, you are right. So first of all, what happened is when the market starts to fall on the first day, first week, first month, you don't know how far it will fall, right? So you are always trying to adjust to how things are. So initially, some stocks maybe we are exiting because it is hitting our stop losses. Then some stocks where we are seeing that okay, the fundamentals are changing, like IT. Those where we are getting out, and then we get into something else, and the market starts falling. So you don't want to take a price loss, so you get out and sit out. So those are the reasons why you've seen more churn. And as and when the market sort of stabilizes, I think you will again go back to seeing what you've been used to, where in Lakshmi the churn is significantly less, and in Vriddhi we are trying to churn to play the shorter cycle. So I think this is this has happened because of the kind of market regime we've been in, and as and when it changes, I think we will sort of again go back to what our normal thing has been. Okay, next question is from Anup. Having a dividend income as passive income, is it a good idea to have it in the long-term future? See, I have two thoughts about it. One is that dividend income in India, typically you will find that in an aggregate, you will get 0.5 to 1% dividend yield in most stocks. Now, are you investing to get 0.5 or 1% return? That is the question that I ask myself, and I tell myself I'm not very keen to get that 1%. It is like it is like the what do I say, the garnishing on top of a food dish. Uh, the main reason why we are investing is to create wealth, is to you know get our portfolio from 50 lakhs, 1 crore, 2 crores to 5 crores, 10 crores over a period of time. That is why we are investing. And uh, that is not going to happen by getting dividends. It is going to happen by buying companies which are growing. It is going to happen by buying companies where management is good, clean. They're not like the Gensols of the world where uh, you know where the probability of losing money is significant, right? So I think that that is what initially my thought is on dividend income. Of course, if we get a chance where you get a one-off, right, where you get maybe some company giving a very large dividend and you want to sort of play that as a special situation, then that's fine. But other than that, I think it's better off if we focus on growing businesses. We focus on solid businesses which are going to give us, which is going to, sort of double, triple our money in the next whatever number of years.
Yes, Anuj, you may unmute yourself.
Anyone wants any, have any other question, you can write on the chat also, or just unmute yourself and you can ask.
Hello, hi Abhishek, Archana here.
Hi.
As you mentioned that Shree Vidhi Fund was one of the, the top performing funds in 2023 or the first part of 2024 during basically the bull cycle. But now, unfortunately, the tables have completely, turned.
Third, yeah,
So, and I believe this, I mean, this fund is new. So probably this is the first time when we are seeing such kind of drawdowns. So I want to
yeah.
ask, what have your, learnings been so far in this phase since say September until now?
Right. So very good question. In fact, the reason why I have sort of changed my or not changed, I've added the market filter to the selling process is basically the additional learning that we had. See, it's if you honestly ask me, did you learn something completely new in the last 6 months? Obviously not. I mean, I've been investing since 2000, so this is probably the 10th time I've seen a 15-20% fall, and uh, it's par for the course. It happens. I know it will happen again. I know it will happen again in probably next 2 years, 3 years, 4 years, sometime. Now, the difference that I want to make is that when we see a fall, starting off or getting to a certain stage, I want to be a gradual seller, right? I don't want to sort of wait till my, say, stop loss is hit and to get out completely, right? That is what we were doing. So we were doing either buying or selling in one go. So now I think we are going to tweak that to buying slowly, exiting slowly. So we will not get, we were anyway not getting the tops and the bottoms, but we will sort of be more gradual, getting in and getting out into positions. Maybe, sort of buying instead of one shot, maybe buying twice or thrice. Similarly, while exiting, maybe, exit in 2 or 3 phases. So that is one major learning, so that it gets more staggered. We take a lesser hit. But unfortunately, I mean, the other, flip side to it is that in a long only fund, right, where you are playing momentum, there is very little you can do when the market falls, right? I mean, uh, it's the unfortunate part, and the worst part is you have to sit through the pain. There is no other way of going about it. That is the worst part of it.
Okay. Okay. And you also mentioned that you have incorporated some market level basically checks while deciding whether you want to get in or get out.
Yeah. So that is what
So
I'm calling the market, regime filter. So basically, see, previously what I was always, doing is you are only mostly focusing on the individual stock that we are holding, right? Or that we wish to buy or sell. Uh, in addition to that, what I am doing now is I am adding a filter in terms of the overall market. So whether it is Nifty or NSE 500 or the mid cap or the small cap index, and creating I've already created a composite score. Trying to put all of this into a quantitative system, so that you are not sort of going all in or going all out in one go. You are sort of gradually going in and out, and you are taking sort of advantage of uh, you know uh, over see what happens is when the market falls, like in Lakshmi. Let me be very, very honest, right? In December or till the end of December, when Lakshmi was not falling, when the overall market was falling for 3 4 months, it made me very complacent. I was thinking that my stocks are good, and they are holding up very well. So we will not fall as much. And I was also thinking, and I've also shared this with you in writings, is that my thinking was that market is going to consolidate. It is not going to fall, right? And that was wrong. And so now I'm trying to add more of uh, quantitative uh, you know parameters, so that you're not basing it you're not basing your judgment solely on your sort of judgment. You are also looking at uh, composite data that is coming from the market. So these are additional points that we are incorporating. So I've always believed in whatever learnings you're getting from the market, you sort of process it back into your process and try to improve your thing, so that this is not the last time the market is going to fall. The market is going to fall again a couple of years from now, and then we should not be making the same mistake that we made this time. Now, next time we'll make some new mistake. I mean, that probably that is going to happen, but I should not be making the same mistake twice. So that is what I do, and I explain, and I discuss this with my team all the time, that we should not make the same mistake twice. So that's basically in the short thing what we are trying to do with the market regime filter, so that we are better aligned with the market. So if the market is overall falling, we are not taking positions. So that is one thing that could have been done better. We could see that the market is falling. So for example, in Vriddhi, we could have actually stepped away and not taken full positions, even though individual stocks were showing promise, right? So that's some interesting learning that we've incorporated now.
Saurabh
okay.
has another question.
No, so I think there was another question from Anup. Is REITs a good investment for long term as to build a rental income? Your take? Yes, I mean REITs. Instead of buying actual commercial property or residential property or whatnot, uh, if it is a replacement for investing in real estate, then REITs is a very good idea, in my opinion. Is it a better idea than equities? I think no. I have a very simple logic. Equities is the best asset class to be in always, because in no country in the world, in the Forbes 100 list of that country, will you find people who own real estate or who own gold or who own something else in the top 100. It is always people who are running businesses, who are the richest people in the world or in any country. You will find one or two maybe film stars or sports people like Sachin or Virat Kohli or Dhoni or something like that. Or maybe in Switzerland you'll find Roger Federer. But other than that, it is always going to be people who run businesses who make the most amount of money. So investing in businesses is always beneficial compared to any other asset class. In short term, something might do well, Gold has done well in the last 1 year, but if you take a 50-year, 100-year view, businesses will always do better. There's is just no comparison. I was just running some numbers. I think BSE Sensex, 1980 to this year, gold has given 10% returns. Sensex has given 16% returns, right? Plus, you can add one. Sorry, yeah, exactly. So, plus you get say 0.5% dividend yield. So 16.5. That difference of 6.5% over a 45-year period is, it cannot be computed. You just put it in a, Excel and see how big that difference is. It just boggles your mind. So REITs is good as a replacement for buying physical, property and investing in them. But there's no replacement for equities as an asset class. Next question is from Saurav. Which sectors in India is in a position to gain with this tariff situation unfolding? And what companies apart from Apple are looking towards India in near future? Very difficult question to answer. You don't know what tariffs are going to look like. But I think every company which has a major manufacturing presence in China is going to look for diversification. So whether you think about auto ancillaries, you think about chemical companies, pharma companies, API manufacturers, you think about engineering companies, you think about electronics, you think about toys, everything across the spectrum. You will find companies looking for replacement of China, and if India does well, then we should be well placed. We should not. I see. My only worry with India is that our political system, whether it is the ruling party or the opposition, whatnot, they should not sort of mess things up. I think India does not expect anything great from the politicians. At least Indian industry, I think, does not expect much from the politicians across the spectrum. And I think the only hope is they should not sort of shoot the country in the foot, right? We should not bring policies, etc., which is sort of retrograde and take us back. Next question is from Archana. In one of our investors calls, you mentioned that you are working to incorporate AI in our investment decision making. Can I ask where we stand on that? It's still a work in progress. We're making slow progress in that. It is a very complex field. I am learning every day. We're using a fair amount of machine learning to unearth different types of data, but are we there in terms of deploying it in a live system? We are not. It is, we are currently in a state where we are using AI for research extensively. We are using AI for idea generation, for looking at the overall structure of the market and many things. But we are not there yet in terms of a full-fledged system. God willing, in some time, once we get there, we are going to get into more quantitative based decision making. So if today, say in Lakshmi, I am taking 80% of the decision and 20% is quantified. Over the next, say, 3 years, I want to get to a situation where it is maybe 60-40, 60% will be quantified and 40% will be my judgment. And I think, see, globally, when I look at the greatest wealth creators, it is actually today, and it is funds where quant plays a disproportionate role. right? And quant is not, the short-term high frequency stuff, but the more longer term stuff that we do. So the more systematization that we can bring in terms of decision making, the more dispassionate it becomes, uh, the better it is for us in terms of our ability to make money. So we will not do away with human judgment altogether in the near future, but the more data crunching that we can do, the more analysis that we can do using AI and using systems, the better it is for us. Archana, your question is, you're not an investor in Sri Lakshmi, so you don't know much about it. Can you please explain how is Lakshmi different from Riddhi and how do you... Okay, so my basic philosophy, let me take maybe 2 minutes to explain my philosophy of buying and selling. And this is irrespective of uh, Lakshmi, Vriddhi, anything else, right? My philosophy of buying is I want to buy growth companies, whether it is long-term growth or short-term growth. So Lakshmi, we are looking for long-term growth companies. In Vriddhi, we are looking for spurts of growth in a short period. So that's the first thing. The second core belief that I have is I am not 100%, I don't know 100% of what is going to happen tomorrow. The entire game is probabilistic. I can make mistakes. The world can change. So I have to be able to protect large, decimation of capital. So I don't want to be in a Gensol-like situation. I don't want to be in a worry energies or a worry technologies kind of situation where you can see, or I don't want to be in a JP Associates kind of situation, if people who are aware of it, or a Vodafone Idea kind of a situation where stocks can go down 80-90% and you cannot exit, right? I may buy a stock like that by mistake. I don't know. I mean, although there's, I think, someone here in this meeting who, he had asked me that should we buy Gensol, I think a few years back, and I told him that, I don't like the company and what they are doing, and I don't think, things are, well overboard. And but I did not know that, they were doing what they are doing. Right? You can never be sure. So what if I had bought a Gensol and it fell 90%? You don't want ever to be in that situation. So you will always want to have a stop loss, right? So in an investment portfolio, you might have a stop loss, which is, say, maybe 30% or 25%. In Vriddhi, you might have a stop loss, which is 12%, 15%, 20%, depending on the kind of stock, the kind of breathing space you want to give, because you will probably never be able to buy absolutely at the bottom and the stock keeps going up from there. That may not happen. So you'll always have to give yourself leeway to be wrong, right? So that is why I will always have stop losses. So that is my second philosophy. The third philosophy that I have is I will very, very rarely buy on the way down. So if I buy a stock at 100, if it is now at 80, I will not buy more. I will wait for that stock to recover and then only buy, right? Because when I'm buying a stock and it falls, I don't know whether I am wrong about my thesis or I am wrong about, I know that for sure I'm wrong about my timing, right? I could have timed it better and I could have got in at 80 if it has fallen from 100 to 80. Right? But at 80, I do not know whether it is going to go to 70 or 60, right? And I might feel that, I could have waited a bit longer. So I am not a proponent of, averaging down. I'm always a proponent of averaging up. If you buy something at 100 and in Lakshmi kind of a portfolio where we are looking for multi-baggers, where we are looking for long-term compounding, I am buying a stock at 100. I'm expecting it to go to 500. I absolutely don't mind, buying more at 150, buying more at 200, right? Just to give an example. So the couple of stocks I already mentioned that I had bought personally when, I was an individual investor. So a Divi's Lab or a Bajaj Finance, I have always kept buying. I was a salaried employee. I used to get my salary. I used to keep buying these stocks. for 4, 5, 6 years. Every month, every 2 months, I used to buy. And I still believe that that is one of the best philosophies to have. So essentially, the difference between Lakshmi and Vriddhi is Lakshmi, we are trying to play the longer business cycles. In Vriddhi, we are trying to play the shorter business cycles. That's the main difference. We are trying to play growth in both. We are trying to, uh, uh, you know, Vriddhi is short-term momentum, Lakshmi is long-term growth. That's the difference. I suggest everyone to invest in both 50-50. Even if you are investing 50 lakhs, I always suggest that you split it up into 25 lakhs each into both these funds so that over a longer period of time, so if you are investing, say, for 5 years or 10 years, you will see that, at times one will do better than the other, but you will get a better, that's what I do. I have invested equally in both. Uh, so over a period, over a 10-year period, you will find that the journey is smoother. I think that's also some an important from a psychological perspective. So that's what I suggest everyone, all of my friends. I do that myself. Next question is from Shobhit. Where and how should one invest lump sum amount at this time with a long-term horizon of 5 years? Like I said, split it 50-50 between Lakshmi and Vriddhi. Right? If you have 5 year plus horizon, it's a no-brainer for me at least right now. I mean, great time to invest if you have a 3 to 5 year horizon. Next question is from Anup. One is getting a return from Shree Lakshmi and Shree Dynamic in spite of my portfolio being down as I have investing long-term gains. Do you think I can sustain in these circumstances? Anupji, I did not quite understand this question. So if you can ask it, either you can unmute yourself and ask the question so that I can understand it better.
दादा अनूप जी has got SWP going on, systematic withdrawal plan. I think उसके लिए पूछ रहे हैं.
उसके लिए पूछ रहे हैं because he's asking about Street Dynamic, तो वो समझ में नहीं आया.
दोनों में उनका systematic withdrawal plan चल रहा है.
Okay. So what exactly is do you think I can sustain in these circumstances? As in, so is your question कि आपका जो withdrawal हो रहा है वो that is not going to deplete your portfolio? Is that the question? Not sure what this question means, so I'll wait for Anup
He
ji
said
to
yes.
clarify.
He said yes.
Acha. So I think, see, if you have a longer, like you said, you have a longer term horizon, I don't think it will be much of a challenge because as and when the market turns, performance is going to go up. Hopefully, we will make a lot more money. So your SWP will continue as usual. So I don't see that as a major challenge. I'm hoping that actually second half of this year is going to be actually quite good for India. In fact, in the lunch that we had this week, we were discussing that we might actually get into a huge, situation where we have huge amount of FII inflows and the market sort of, gets into a bubble kind of territory. I don't know whether that will happen or not, but it's the FII flows. I am personally very, very convinced. I mean, the dollar is going down. BlackRock CEO's letter to investors saying that they are looking for exits from, taking money out of the US markets, going into emerging markets. And these are funds which have $2.5, $3 trillion. 1% of that is, I think 200 billion or something. So it's crazy money, or 20 billion. Next question is from Adarsh. What are your thoughts on Trent? There has been good significant correction, but fundamentally a good company. Any chances of including this in Lakshmi? So Lakshmi, we rode Trent for 3 years. I bought it when on the day one when we launched the fund, both Trent and Varun Beverages. We exited both recently. Trent, I think, again, is going to do well long term, but I think again the competition is getting tougher for them. Valuations has cooled off, so again we might take a relook at it at some point in time. But it is like selecting the Indian cricket team. आपके पास you have 11 positions uh, in your team, so आप किसको डालोगे टीम में, right? You have to pick the best 11 you think at that point in time, and you cannot take all batsmen or all bowlers. You have to have a good mix. So similarly, you cannot take everything from one or two sectors. You have to have a mix of sectors, because again, probabilistic market, right? You don't know what tomorrow will bring. So yes, I mean, Trent is something very close to my heart. We made a lot of money in the fund as well. So is Varun Beverages. Varun Beverages, I still continue to follow the company, although we've sold out. I mean, their results were quite good. But again, long-term headwinds are slowly sort of cropping up. So we need to be, cognizant of all those, and valuation-wise, etc. These are not cheap. So we are, I think, getting into a phase where we want to look at growth at a reasonable price kind of a mode. Next question is from Archana. Can you remind what is the rebalancing frequency in Vriddhi? There's no rebalancing frequency. It is completely dynamic. We sort of every week we look at the system and look at the top 10 stocks that the system throws up, and if there is anything which is significantly better than what we currently hold, we make the switch. If it is not the case, then we hold on. That's the way we sort of play Vriddhi. Okay, I think we've spent about 1.5 hours. We've got 4 minutes till 1. So maybe if there are any last questions, we'll take. Else we will try and close here.
We have another question from Anupji.
Anupji, Vijay Kedia is investing in the China market. Any chances we can enter? Don't know if it's a relevant question. It is always relevant. Every question is relevant, sir. I know Vijayji very well. We've interacted very, quite a lot. He's a brilliant investor, great person. See, my thought on investing abroad. I used to personally invest abroad in the US. I've stopped doing that. I'll tell you why. One is it is very complicated. Now with the LRS rules, the TCS rules, you have to put 10% upfront. All of that has become a hassle. Income tax becomes a hassle. So unless your personal portfolio is above maybe 500 to 1,000 crores, honestly, it doesn't make sense. And that's what I feel, right? Because the hassle is too much. You can play global markets through mutual funds. There are a few, but I think in India, when global, big investors want to come to India to invest, why do I want to go abroad and invest somewhere else? That's my limited point. For Vijay Kedia, it might make sense because his portfolio is huge, and he's putting, like I think in one of the discussions he was saying, he's putting maybe 5% of his portfolio, right? So it's more a experimentation, diversification, little bit. It's not that he's putting 50% of his portfolio. So with that, I think we'll close for today. My request to you is, whenever you have a question, drop me an email at equity@shreerama.co.in. I'll try and answer your questions as soon as possible. And I we will anyway have these sessions once a quarter. If any one of you are coming to Calcutta, feel free to, let us know, and, we can meet face to face. Mohit, maybe we can do a face to face session sometime this year. I know we've
Sure,
been
Gaurav.
planning one
Yes.
for a long time, but let's see. But I think a lot of our investors are geographically, dispersed. So if you are doing a session in Calcutta, maybe a lot of them cannot attend. So we'll have to sort of right now uh, keep doing these online sessions, and will definitely have once a quarter. But I want to sort of just let you know that I'm always available on email. You can just send me a question, send me your thoughts, send me your comments at equity at shree-rama.co.in, and that is my email ID. You can reach me directly there. So thanks all of you for joining. Thanks Mohit for arranging this, and Gaurav also. Thanks for arranging. Thank you.
Thank you everyone for being over here. Thank you everyone.